we're going to have a recession. It's going to be very salient, very acute, and it's going to last longer because the Fed pivot can't be the same, knowing that 40-year inflation was just several months ago. 40-year high inflation. It just can't happen. Well, how you doing this morning? Are you disgusted? You should be disgusted this morning. I am really disgusted and aggravated this morning. Let me tell you. So, for the better part of 14 years, Dunnigan, the Federal Reserve has been practicing zero interest rate policies and engaged in some form of quantitative easing, various amounts, between 50 billion, 85 billion a month. For 14 years, they have done this. Finally, in March of this year, after 14 years of monetary and fiscal madness, they started down the road to normalcy, raising the Fed funds rate, off of 0% and getting it, in their view, to a restrictive policy. So after 14 years of profligacy, if I said that right, profligacy, 5 months, 5 freaking months. And we had today the article from the Wall Street Journal from the Fed Whisperer saying, maybe starting in December, after the 75 basis point rate hike that we're going to get November 2nd, maybe we're going to stick the landing and just maybe hold rates there, or just take a pause and see what's going on around us. Isn't that amazing and disgusting? In 5 months, it only took 5 months. They only started normalizing policy in March. 5 months as opposed to 14 years, and we're already seeing them panic. They ain't even done again. They're only at 3%. They're not at 5, not 4, 3. At 3% historically is a very low Fed funds rate. I click on to see what's going on with the Treasury market because that's the nucleus of everything. See what's going on with the dollar. The dollar is surging. Long duration Treasury yields are up another 14 basis points after being down 30% this year. And then all of a sudden, mysteriously, we get an article that, hey, we've gone too far, maybe we should stop. So what does this tell us? Where does the rubber meet the road? The Fed is, as I said the whole time, the Fed is going to aggressively try to normalize policy. They have done that. They're going to fail miserably and destroy the entire markets, everything, fixed income market, crypto market, SPACs, junk bonds. They're going to destroy everything. The credit markets are going to freeze. My guess is by the end of the first quarter of 2023, and then you're going to get your big dovish capitulation. And that is, by the way, what I've been waiting for. And I won't wait till that exact time because my model will pick it up ahead of time, hopefully, God willing. But that's when I'm going to increase my goal position because guess what? They're never going to be able to prosecute on their plan to raise interest rates to 4.5%, 5% in early 23 and then keep them there for a very long time without destroying what they've created. And the reason why, and I'll let you in a second, I just want to wrap this up. You just can't deform markets for over a decade, 14 years plus. Actually, you go all the way back to the year 2000 or even 1987 if you want to. Well, I don't know. Again, I don't think it's going to happen. I'm not sure it's going to happen in the fourth quarter. I think by the Q1 it's going to happen. But of course, that's my best estimate at the time. But it's not going to be, I don't think it's going to be the normal pivot. So normally when you think of a pivot from the Fed, you're talking about, hey, oh my gosh, we have a problem here. We're going from, in 2008, Bernanke went from 5.25% to 0 in just a matter of months. It took them less than a year to get there. And we got better at it all the time. In the pandemic, we went back from, we were at 1.75 to 0 in weeks. So we're getting better at going how fast we get to zero interest rate policies. I don't think we go back to zero. What I think they will do first is say, oh, let's put a salve on this thing. Let's just like they did in 2018. Remember in December of 2018, the Fed funds rate was 2.5%. The Fed, what did the Fed say? The Fed promised to stop hiking. That's the first pivot. Then shortly after that, by July, in July of 19, they ended quantitative tightening. We're going to follow, I think, something very similar where we just first stop promising to hike rates and then we stop QT. But the damage is going to be severe during that time frame. I mean, the recession is coming. In my estimation, Donegan, earnings are going to fall anywhere between 10 and 30%. That means the S&P is going from anywhere between 2,000 and 3,000. If you do the math, just at 13 times earnings on the nadir of the 30% decline, 15 times on just a 10% decline. So maybe we go down. The minimum we go down to is 32, 3,300, but we can go all the way down to 2,000. There's gonna be a lot of damage done to the credit market. So the pivot is going to be attenuated and protracted as compared to previous times. Meaning, in other words, instead of going right back to zero, we're going to slowly go back to zero this time, much more slowly. If we even go to zero, maybe we go back to 2. And quantitative easing will just be on the periphery. So maybe they, instead of promising to buy everything like they did in the pandemic, they said, give us your junk bond, give us your corporate debt, give us your commercial paper, give us your mortgage-backed securities, give us your treasuries, give us everything. We have an unlimited QE policy here. They're going to say here, we're going to have a limited window open for you to send us your paper, but it will be at a penalty rate. So that's what I'm thinking. So in other words, I guess if you want to wrap this up, we're going to have a recession. It's going to be very salient, very acute, and it's going to last longer because the Fed pivot can't be the same, knowing that 40-year inflation was just several months ago. 40-year high inflation. It just can't happen. Well, I think it's going to be really good. I mean, I hate to say it. I know you hate to hear this, but it's going to be really good for the precious metal market. I mean, we're going to finally learn that what we knew all the time is that hey, you can pretend and scare the precious metal complex into thinking you're going to have real interest rates forever, but you can't. The economy is so over leveraged and so addicted to asset bubbles that real interest rates just don't work. So we're going to put a cap on nominal rates first. That's the first thing we're going to do. So we're sort of like what Japan did. Maybe we just say, hey, listen, the 30-year treasury can't go any higher than 4%, whatever the number they get. And they're going to do that by creating money, which is inflation. So real interest rates will then fall, which is rocket fuel for precious metals. I mean, I've been out of the market, other than a small physical holding, 5% physical holding, I've been out of the market for most of this year. Correctly so. I'll get back in when I have a very good feeling. The model gives me the assurance that nominal rates have topped out and real interest rates are going to fall. That's coming, I think, by Q1 of next year. Real interest rates, if you look at break-even spreads, we are positive. If you look at CPI, we're very negative. But it's not the actual number. It's the rate of change that I look at. So real interest rates are rising. That's undeniable, and everything's predicated on that direction, that rate of change. So that's why gold and gold stocks have been horrible this year so far. They don't like rising real interest rates, not actual real interest rates the way you just calculated it using a CPI deflator, but just the direction of real interest rates is no good. And the dollar. So if you have real interest rates that are rising and a soaring U.S. dollar, it's not good for gold. I think the exact opposite condition is setting up for